All right, we wanted to create a quick video to kind of help some people here in getting started. So there's a lot of information we're hearing about a lot of different companies that are blowing up out of nowhere, especially in 2020. I mean, if we take a look at Zoom went from $100 a share and zoomed its way up to $500 a share out of nowhere. And everyone is wanting to jump on and get into stocks, but how? Where do I get started? What do I do? So we wanted to give you a quick how to on that. So the agenda today, we're going to talk about some basics of the type of stocks, ways you can measure stocks, which is important because we get a lot of information, but we really don't know what to do with that information. And then how to create your own plan to invest. Stick to your strategy versus what everybody else is doing because there's many different things that people are doing for different reasons. And if we're trying to do every single thing and not knowing why we're doing it, you can easily get lost. And then we're going to set up your broker. We're going to talk about Robinhood, which is relatively simple and easy to use. I like for anyone who's beginning and just getting started. This is a pretty good one that we like a lot. And then we're going to walk through a demo to show you how to buy and how to sell a stock. Now, before we start, I have to throw a little disclaimer out there. By watching this or reading this, if you happen to have the ebook version of this, which is coming soon, if you're by watching or reading, can't get my words out today, this, you are saying that you understand the following, that I'm not a financial advisor and this is not trading advice. This session is solely for educational purposes. There are risks involved with investing, and I'm not liable for your gains or your losses if you decide to act on this information. Had to throw that little bit out there. So now let's get started. So the types of stocks. Stocks are simply a share of a company, and every company does not provide these. There are two different ways that you'll hear about shares of a company that you can purchase. There's private stock, which is a company that shares its value with potential buyers, but it's not sold on a public stock exchange. And then there's companies that are public, which they're sold over a public stock exchange that anybody can buy into. Both of these are legal. Both of these are protected per se by the government. But what we have and you'll hear about is something called IPOs, which is an initial public offer. This is when a private company decides that it wants to offer shares of its company publicly on the public stock exchange. So that's the initial public offer, the first time that they're offering it to the public. Then there's what we call value stocks. Value stocks are stocks that are already public that are sold below their value. So think as value stocks as a really great company that has a much higher value than what it's currently being sold for. Think of it like, okay, let's talk about Jordan. Jordan shoes. Normally, you can find some Jordans for about, let's say, $300. But for some reason, it's selling for 150, and you know that the value of this brand will cause it to go back up to 300 or higher over time. So you're going to go ahead and buy them for 150 now, so that as it gets back to normal, as whatever is happening on the market that's making the value so low, then you're going to gain profit from it going back to its normal value and then continue to hold on to it if you choose to. That's what value stocks are. Value stocks are stocks for great companies. This isn't just for any company. These are for great companies, and we're going to talk about fundamentals in a moment. That you're catching them during their bad time. Let's say it was a big lawsuit and they had to shell out hundreds of millions of dollars, and because of that, their stock went down for a little period of time. They can weather the storm. It's just for a little period of time. They have to walk through that drought. And so you're buying them during their downtime. Then there's income stocks. Income stocks are basically stocks that give you dividends. Dividends are a quarterly check that you receive for just merely holding a share of stock. So what happens is a company makes their profits and they can decide whether they want to pay monthly or quarterly. Some pay every 6 months and some pay once a year. Most dividends are paid quarterly. We like quarterly or monthly. We don't want 6 months or a year. That's too long. And so what they'll do is they'll take their net profit. That's the amount of money that they make after they've paid out all their employees, all their bills, whatever expenses that they have. And what remains is their net profit. That company will decide that for this quarter, and each quarter a decision is made, we're going to give out, let's say, 10% of all our profits, we're going to give to our shareholders. Shareholders are all the people that own stocks in their company. And let's say by the time they give out this 10% of this total amount of profit, it may equal 65 cents per share. So for every share of stock that you own at that current time, you'll get 65 cents for each share. So if you own 100 shares, 100 times 65 cents is what you'll get in the form of a check, or in this case, most of the time now, because everything's electronic, you'll get that sent to your brokerage account. And there's things that you can do. You can allow it to automatically reinvest in that same company. You can't auto reinvest into another company. It will have to be into the same company that gave you the dividend. So let's say McDonald's. McDonald's gives about 65, between 50, 65 cents per share. And you own 100 shares, it's going to 100 times what they're giving. It's going to take that money, however much it is, and buy however much value of that share it can purchase with that much amount. So if the stock is $50 and you get $1 in dividend, it's going to buy for you $1 worth of that stock. So what happens is compound interest. We love that word. It is fabulous. It is your friend. Compound interest over time doubles itself. Think of your mortgage. If you own a home and you look at how much you're going to pay in the end, once you've paid it off in the 15 or 30 years that you paid for it, you're going to pay more in interest than you paid for the actual house. So let's say you bought a house for my house was 185,000. After 30 years, I would have paid almost a million, 800 to a million, 800,000 to $1 million for that home, depending on what the interest rate is or was when you bought the house. Compound interest is why. That's why it's best to pay your house off as soon as you can if you don't want to pay all that interest, but it's also good for tax purposes. So depending on what your strategy is and your purpose for buying the home, that could change. But just some food for thought there. But that's the same thing that happens with dividend stocks, or what we call income stocks. Income stocks are stocks that give us income just for owning shares of it. We can also gain from its value growing. So using the same example, McDonald's, when I first bought McDonald's, it was $50 a share. Now it's $200 a share, and they've been giving dividends the whole time. So it's a win-win situation. You get paid in dividends for owning it, and you can get paid for your capital gains or the growth of that stock. Then we have what's called growth stocks. Growth stocks are just as they sound. It's stocks that you buy as the company is growing. Growth stocks tend not to give dividends because they use all the money that they're gaining to further their growth. That's the whole purpose. So typical stocks that you would think of as growth stocks, Tesla. Tesla doesn't give out dividends because they're taking all their money that they're making to grow the company. Amazon, another good one. Amazon doesn't give dividends. Instead, they try to make the value of the stocks grow as much as possible. I remember when Amazon only sold books. Their stock was only $9 a share. Now it's $3,000 a share. So either way, there's ways you can make money there. And then there's penny stocks. Penny stocks are stocks that are $5 and below. And they were given the term penny stocks because they're cheap. Now, you're not going to buy a penny stock and expect it to grow to $1,000. They're a penny for a reason, or they're at that low value for a reason. Now, does this mean they cannot grow or would not grow? That doesn't mean that. It's very possible. It's that the percentage of that happening, the possibility of that happening is a lot lower than a company that is in a penny stock. But we still like penny stocks because I can buy a whole lot more of more shares of a stock that's $1 than I can of a stock that's $1,000. And I can wait for that stock to go up to $2 and then sell it. Either one of these types of stocks works. I highly recommend finding what works best for you and what your strategy is. So, three things you have to know that we believe is very important when you're investing is to know how you're measuring. You have to measure a thing to know a thing. So there are three ways we measure stocks. We measure stocks by the fundamentals, and fundamentals are simply what is this business and how is this business performing? Buy the jockey, not the horse. A person can have a wonderful idea, but if the management sucks, so does the idea, and so does the possibility of its growth, most times. So when you know the management of a company, when you know the balance sheet of a company and the income statement of a company, how much debt do they have? How much cash do they have? Such that if a pandemic comes, how well will they function? How will things go? That's what fundamentals are. Fundamentals are the foundation of value stocks because you're not buying on the price with value stocks. You're buying on the foundation that this business is an excellent business. That's fundamentals. Fundamentals also saves you or helps you when there's a downturn or when there's a dip, is what we like to call it. When the market just goes red, it flatlines, and all of a sudden, these wonderful companies that we love, we're going, what is happening? Well, if you know the fundamentals of the company, you know that, okay, they have money in the bank, they can survive, they have great management, they know how to pivot when disruption is happening. Those are companies that we like to call our conservative companies. They're not going to get you as much money as fast, but what they have is foundation and something that they can last on. Now, technicals, when we're talking about technicals, we're talking about charting. A lot of people don't like to do this. Even me, myself personally, just started really getting into charting maybe last year or two ago. And charting you typically do with day trading or if you're selling options, things of that nature. Is not a requirement, but technicals kind of guide you on based off of the history of a stock. If the history of the stock says that it typically goes down during a certain month or it goes up during a certain month or time frame, it's a way that can kind of lead and guide you to what's going to happen in the future. You use that as a guide and not as a promise. You use it as a way to find ideas, but always validate your ideas. And the third one is called sentiment. And most newcomers to investing, this is the only thing they trade on is sentiment. Sentiment is emotional, it's sporadic, and it's short term. When we talk about sentiment, we're talking about how people feel about this company right now. What is the news saying about this company right now? And the reason why it's short term is because news changes every day. Today they may love you, tomorrow they may hate you, and then they'll love you again next month. With that, it causes a roller coaster. And if you know the sentiment, if you're trading short term, then you trade on rumor and sell on the news because you're buying it based off of what you know is about to happen or could possibly happen. And when everybody else finds out and either buys or sell, you have already put yourself in position to make a gain off of these emotional habits that people have. So we call it following the herd. If you know what the herd is going to do, then you make the move, the best move you can make in anticipation that the herd is going to do a specific move. And you know these things by knowing what the sentiment of that company is at a given time. In order to trade based on sentiment, you have to be in the know and knowing not just what you see on CNBC or from an analyst, because there's information that flows before it even makes the news. This is where research comes in. This is where paid subscriptions for information, because this kind of information doesn't come free. Um, that's where that comes in. And at StreamlineiG, one of the things we do with the patronage that we get is we buy into those subscriptions so that we can share that information with our executives here, our patrons, as they call it. So those are the three things that you're measuring. I like to look at all three. It's good to know all three. How, what is the foundation of this company? Now, growth stocks, typically, you're not going to have solid foundation yet because they're growing. Okay, if they're growing, I need to know what is the sentiment. There isn't much technicals I can go by, but I need to know the sentiments of this company very well, because that's going to help me to know what direction this company is going. Right now, at the recording of this video, electric vehicles are the hot ticket. Everybody's jumping on them. So if I'm going with a company that's a growth company and it's in a hot ticket market at the current time, then the concept of money coming in to help them to grow will probably be there. So that's how I mix and use different measurements to measure a company and what my move is going to be on that company. This is highly important. So I recommend for everybody that I talk to, even for myself, is to always have a investment plan. Now, do you want to just invest long term, where you just buy your stocks, they sit there, and you don't have to worry all day, you check them every month just to see how things are going, but you're not looking at it all day, every day? You normally would put into these type of things conservative stocks, things that are on solid companies or value stocks, and maybe even some income stocks that you can build a drip with, a dividend reinvestment plan. And that's where you're buying income stocks that reinvest in itself. And there's some tax savings there as well, that you may want to talk to your tax person about, as far as with drips, to keep you from paying some taxes on that income as well. But with long term, you want to have solid companies. From my plan, I will only have companies that provide dividends, that have been in business for at least 10 years, that are solid. For example, AT&T, pretty cheap right now. You can get that for less than 30 bucks. But they give dividends, and they've been giving dividends for years. They've been consistent with their dividends. I like Coca-Cola here. Once again, Coca-Cola has been around for decades. They've been giving dividends for decades. But what they don't do is grow a lot. I'm not buying them for fast growth. I'm buying them for long-term consistency. That's what long term, that's how you kind of set up your view of a long-term plan. Then there's short term. Short term is growth stocks. Growth stocks, penny stocks. When I buy growth stocks, I buy them with the plan of, okay, I want to see you grow. And if you turn into a conservative stock, great, but that takes at least 10 years to meet my strategy for myself. But I might just buy something for its growth and then take my profit, sell the stock, and move on and go find something else that's growing. Tesla, let's say Tesla is a growth stock. It's not considered a conservative stock at all. So Tesla's a good one where, okay, I bought it at 79 bucks, and I was kind of torn for a while because the fundamentals of the company has not been great. They just started being in the green on their balance sheets, on their income sheets this year in 2020, 2019, I'd say. So for many years, they were losing money. NIO, another great one. NIO is losing money, but the idea that they're building something makes the value of the stock grow. That's a tricky one because you're buying on hype, and hype can only take a stock so far as growth. So I might buy a stock until I feel the hype going away, and then I might sell it. And then I might buy back into it a little later. It all depends. And this is where knowing what my strategy is for each stock I buy becomes important. And then last but not least, mixed method. This is actually what I like to do here at StreamlineiG, It's a combination of all three. It's a combination of all of those: conservative stocks, growth stocks, income stocks. Where the plan comes in is, okay, how much of the portfolio is going to be conservative? How much are we going to put into growth? And how much are we going to put into income? That's another alternative. The concept here is know what strategy works for you, and you trade on your personality. Some people can't handle the risk, so they might need to stick to long-term conservative things that are pretty, their volatility, which is how much they move. Think of a roller coaster, how many ups and how many downs it has. Conservative stocks don't have as many ups and downs. They stay kind of steady, slow incline up. Or you're a person that, hey, I need to buy on the dip. Every time that roller coaster comes down, I'm jumping on. And when it goes up, I'm jumping off. That's short term. Or it could be a mix of all of those. So identify what works for you. And then, last but not least, setting up your brokerage. We like Robinhood for beginners. And I'm going to go over a quick review real quick with you. So let's see and pull it up here on the screen. All right, so this is my test account here. And if you notice today we're kind of down, it's down like 70 something bucks. But then when you go to a week, it was okay, down $3, $4. A month ago, we were up $1,800. Now, mind you, started this account with $1,500 about 6 months ago. 3 months ago, we were up almost what, 47%, 46.51%. And just to show you, over the course of a year, like I said, I only started this account about 6 months ago for testing purposes. There are different things we're trying out here. We're throwing in some options. As you can see, we're kind of having a red day over here. But once you get your account set up, if you go to Robinhood.com or download Robinhood on your phone, download the app. Yes, it is going to ask you for your social security number. Any investment tool that you're using is going to require your social security number, because you're going to get a tax form at the end of the year every year showing you your profits. If you pull those profits, yes, you will have to pay some form of taxes on them, or it will be included. So how do you use Robinhood? So I'll start from the top. You can actually go through and see how you're doing over 1 day, 1 week, 1 month, 3 months, 1 year, or all time. Your buying power is how much cash you have that you can buy stocks with. I can easily add more buying power by just clicking and depositing funds once you have your account set up. All right, margin, don't worry about that because you guys will not be using margin. If you're using margin, I would recommend using a different type of account altogether because you're playing with big money at that point. All right, if we scroll down, if you don't know what to buy and you're looking for something in a particular area, let's say you're looking to invest in cannabis. If you click on that button there, it's going to give you a list of different cannabis companies that you could take a look at. Our favorites we've been playing around with, Aurora Cannabis, ACB. And you'll see us put this in parentheses, these 3 letters or 4 letters. That's called a ticker symbol, and it's the shortcut name for a company. And we'll use that in just a moment. Sundial Growers was or still is, a penny stock. So let's take a look. Actually, I'm gonna go back to our original screen. I'll go back to our portfolio here. All right. So let's say I call out a company named Sundial, and I give you the ticker symbol SDN. If you go to the search, you can either type in the name of the company or you can type in its ticker. So I said Sundial, and Sundial is SNDL. You see that ticker symbol, you see that name. I could have typed in the name of the company, Sundial. Let's say you don't know the ticker. Same thing, it's going to give you the ticker symbol and that company. If you click on it, you can see how well that stock has been going over a month, week, day, year, 3 months. You'll see that it's gone down through a period of the year, as most stocks have. But you'll also see over the course of 5 years, this is a pretty new company. They were just listed August of last year. So it's a growth company. They haven't been around that long. It's also a penny stock. You see it's only worth 49 cents or 0.4912 per share. So in this case, we bought 50 shares of this. actually bought more than that and sold it, and then bought back in because I use this short term as a test. So you could buy, let's say I wanted to buy, we'll go ahead and do a test. And let's say I want to buy 10 shares. Over to the right-hand side, I could either buy Sundial or I could sell it, whichever one you want to do. So let's say I want to buy 10 shares of this. I type in 10, it's going to show you the market price. The price is what it's currently going for while the market is open. If you try to purchase outside of the hours of when the market is open, which is 9:30 to 4 p.m. Eastern time, it's going to tell you that you have to buy at limit price, where you tell it the most you're willing to pay. Because when the market opens, it may not be the price that you saw when you first put this in. So by default, it's market price. I want to buy 10, and the total cost of buying 10 for me is $4.91. I'm going to review my order. It lets me know that you're good to buy this. I hit buy, and then it's done. Done. You'll notice if I hit reset my screen here, I now have, instead of 50 shares, I own 60 shares now. Well, let's say I want to sell 5 of the 60 shares I own. I can go in, I hit 5, I make sure I set it to sell SDL. 5 shares. This is the price I'm selling it for. And the estimated credit I'm going to get at this time is $2.45 if I were to sell right now. Well, why wouldn't I want to do this? Well, let's say, okay, it's on a downtrend. Remember I said about the roller coaster, these ups and downs? Welcome to the world of investing. It happens no matter what you're investing in, whether it's stocks, real estate, businesses, they have their ups and their downs seasons, I guess you would say. You buy at the low, or what we call the dip, and you sell at the high. So let's say we were right here at this time today. At 9:55, I would have bought in right here, and I would have sold right here if I was day trading. Day trading is when you buy stocks and sell them in the same day. Don't recommend that with Robinhood because you can only do that 3 times within 5 business days, and then they'll lock your account. So buy and hold at least for 24 hours. But let's say this was 24 hours later. Let's say it was here. Let's say I bought here on the 25th of November and I sold here on December 2nd. That's 7 days, 1 week. In 1 week, it went from here at 24 cents a share to here at 80 cents a share. So if I had 100 shares that I bought at 20 cents, or what were we? Let's say 25, and I sold that same 100 at 80 cent minus 25 cent times 100 would be my profit if I sold right now. So let's say these 5 shares were in that time range, and that's what was happening. Whatever the total estimate credit you're going to get, that is how much money is coming back to you. That's how much you spent plus how much ever it grew. Now, if you're selling it and it did not grow and it was a decrease, then that's just how much total money you're getting back. And you're taking a loss based off of whatever the difference was at that time. So I would hit review order and I would simply hit sell and done. Now, if I take a look, I'm going to refresh here. I now have 55 shares, and that money that I made went back into my buying power. And that's simple. Now, trading options, that's for more advanced people. You can make money trading options, but it is more risky. That's going to be something that you probably want to get a bit of training on, and we definitely have a few recommendations on some courses there. I don't believe in reinventing the wheel. If there's some really good products out there to teach you, I'd much rather share and help someone else to grow their business than to try to reinvent the wheel when there's great products out there already. And we have a few that I personally have taken myself that were phenomenal. So now if I go back to my portfolio here, these are the options that we're playing around with this week. As you can see, Sundial is one of them. But you can see the list of stocks and you'll see their ticker, how many shares you own. And like I said, this is our test account. So we got quite a lot of stuff in here that we're testing out. And so on the right-hand side, where you see a little chart, you can see how things are going for the day. Right now, the market is on a downtrend all the way around across everything. It's happening to everything. Is that a bad thing? No, it comes with, it's just like riding a roller coaster. You're going to have your ups and your downs. You jump on the ride on its lows, you enjoy your ride for as long as you want to, and jump off the ride at its highs. So in this case, Uber, 7 shares in this test account. Since we've owned it, it's grown $106.23. It's green because right now it's on an uptrend. If I click on Uber, I can see more information. As a whole, well, for the day, it's down $1.47. But for the over the course of the year, this company has gone up by 88%. It's gone up by $24.87. That's why we don't spend a lot of time looking at this one day, because it may freak some people out. Oh, I'm losing money. I'm losing money. But last week, look what you did. Okay, we lost $1.73, but over the month, you gained $6.25. Over 3 months, you gained 15 per share, by the way. Over 1 year per share, it's grown $24.83. So overall, the trend of this company is going up as a growth stock. Uber is a growth stock. As you can see, they've only been on the market since May of 2019. So now if you take a look at the information provided to you, you can see how much on average we paid when we bought the 7 shares. On average, we paid $37. Portfolio diversity, that's the percentage of our total portfolio that we have is put into this particular company. Now, today's return and then the total return over time. Total return since owning these shares of stock has been almost 40% return. That's 40% return on the money that we put into it. You can't do that in anybody's savings account in a short period of time that we've owned this. We've owned Uber less than a year. What savings account can you earn 40% in less than a year? Unheard of, nowhere. All right, they'll give you little information about the company where you can click read more and see what they do. I like to read and know this because a lot of times the way a business earns money is not the way we know that they make money. For example, with Uber, I had no idea that Uber was in the trucking business. Not so much that they're doing the transportation, they are handling the contracts. They're being the middleman between trucking companies and businesses or import and exporters. Did not know that. They are major in that market. Did not know that. It's the things that we don't know about a business that can make a difference between winners and losers. You get to see who the CEO is, how many employees, where they're located, what year they were founded, their average volume, and then their market cap. How much of the market do they have the capacity to serve? Definitely, I always love to read the news. This is how a quick way on your phone, it will pop up news, what's going on with that particular company. Your analyst ratings, buy, sell, and then what they feel. Once again, this is sentiment. And then this is we pay for this research report. It's only $5 a month with Robinhood, but we get a report from Morningstar and some other companies and what they are feeling and saying and what they feel the fair value is. Now here they're saying the fair value is $61. The stock is currently selling at $52. Remember what we said about buying value, buying at the dip? Well, if this is what the experts believe that this company should be worth, $61 a share, but it's only 52, what does that say to you? It says to me, maybe I should buy some more. All right, earnings date is once a quarter. The company will have a conference call with its shareholders, and yes, StreamlineiG tries to attend as many of these as we can because you get great information about what this company is doing, how they're doing as far as fundamentals, and what their plans are for the future. A lot of things that people learn about 3-4 months later, we already knew about and bought it on the rumor. We bought it because the company said that this is what they're going to try to do. But you may not hear about it on the news until 4 or 5 months later. The key to this is that when statements are made in these meetings, these investment calls that they do once a quarter, every company that sells their shares on the market has to do these calls. It's a requirement. Sometimes things that you hear about has already been baked into the price. What do we mean by that? Things that you may, let's say Uber is going to start delivering pharmaceuticals. They're going to start delivering your prescriptions. Well, we might have known about that 3 months ago, and their price might have already went up based on that information. Therefore, when you hear about it on the news, it's already baked into the price. Now, it doesn't mean that the price still won't go up. It may still go up a little bit based on the fact that the herd starts running to it, which can make the price go up as well. So knowing that information becomes important. That's why paid subscriptions are so important, because they go to all these meetings. They stay in the know of what's going on with various companies, things that you don't have to do, so that you can just get the cliff notes versus sitting in all those meetings. And sometimes they're so boring. Oh, you have no idea. But it's great information. And then the history, what have you done with it? So as you can see, we placed some options on these. We bought call and puts on these as well. And then it shows you some of the other companies that companies may own. All right, so that's pretty much the breakdown of Robinhood. I showed you how to buy and sell, which is the main thing. Showed you how to see what you own, and you can take a quick glance. It may look a little bit different on your phone. So you have your portfolio. When you first sign up, if you invite others, that you can get free stocks. You'll get a share of a stock for maybe about $5 worth of a stock, and then the person you invite gets $5. That's a good way to add more stuff as well. How much cash you have to buy with. So my purchasing power in this test account is $819.04. That's stuff that I have not bought anything with that I could buy something with right now in this test account. Dividends. Remember we talked about dividends? Well, okay. There's a pending dividend coming on January 7th. We just got a dividend or a pending dividend that's coming on Qualcomm on December 17th. Now, Qualcomm, we don't even own a whole share of Qualcomm, but we're getting 75 cents. Now, what if we had multiple shares of Qualcomm? Then for each share we're getting, we will get the whole amount. I believe it's like $1.15 per share, something like that for Qualcomm. McDonald's, our buddies. In this test account, it isn't a whole share, it's a portion. One thing I didn't show you is how to buy in portions. So let's do that. Let's go to, and as you can see, I have dividend reinvestment turned on. So the amount that they're giving $129 per share. This test account owns 0.18 of a share. That means we bought in fraction. And for that fraction, we're going to get 23 cents. So because they are given $1.29, we own a fraction of a share. We're getting the amount that fraction is worth. And that money will go back into McDonald's and buy more McDonald's for us. So it's going to buy 23 cents worth of McDonald's. Now, the way you would want to do this, or what I would do, is I would buy multiple of something, so that instead of just getting 23 cents, I want to buy enough to, how much would it take that my dividends will buy me a whole share? And that's how many of those I would buy in my real account. All right, but let's take a look. Let's say McDonald's, since we're talking about McDonald's, their ticker is MCD. Let's say you wanted to buy, you couldn't afford to pay $206 right now. Okay, no problem. You want to invest in shares, or do you want to invest by dollars? If you change it to dollars, you can say, okay, buy me $20 worth of McDonald's. I review order. It tells me, okay, you're going to buy $20 at the rate of 200, because that's the value of it right now. I hit buy. And before I hit done, you'll notice we currently own 0.180898 of a share. When I hit done, and I'm going to refresh my screen, we only bought $20. Now you notice that we're now at 0.2775. So that lets you know you don't have to buy a whole share. You can buy based off of where you are. If all you can afford is $5 a month, I can buy $5 of McDonald's. If all you can afford is $1 a month, you can buy $1 of McDonald's. If you can afford to buy a whole share, you can switch back instead of buying dollars back to shares and buy the number of shares you want. So that's a quick review of Robinhood, how to buy and sell stocks off our test account there. If you have any questions, please feel free to reach out to us on our Patreon account, and have a great day.